Hey, what's going on, everyone? In this week's real estate market update, we are going to take a look at the real estate market on a national level. We're going to take a look at existing home sales. We're going to look at median home price. We're going to look at inventory levels. We're going to see what's going on in the mortgage industry. And then I'm going to give you a mortgage rate update to kind of see where they are today and potentially where they are headed. After all that, we're going to circle back around to the Sacramento market. I'm going to share my thoughts on exactly what is going on. Welcome to Macro Thinker. If you are new to the channel, please consider smashing that like button to help push this content out to more people, and tap that subscribe button to see more weekly videos on finance, real estate, and investing. My name is Lewis. Let's get it. All right, so let's jump right into it. Up on the screen, I have an article from the National Association of Realtors, and it's titled Housing Market Reaches Record High Home Prices and Gains in March. And so I've already read this article so that you don't have to, and I've highlighted all of the key points. Let's take a look and see what it says. So total existing home sales actually decreased 3.7% from February to a seasonally adjusted annual rate of 6 million in March. Sales overall climbed year over year, up 12.3% from a year ago, which it was currently in March of 2020, it was sitting at 5.35 million. So now this is really fascinating. What it's saying is that from February to March, existing home sales has actually decreased slightly, probably due to a lack of inventory. However, from a year ago, home sales have increased by double digits, over 12%. Now, what's interesting to think about is that back in March of 2020, we were just starting to face the lockdowns due to the pandemic. So I'm wondering if the reason why home sales have increased so much is because some of those listings that were on the market and available last year maybe had to be placed on hold or be pulled off the market due to everything that was going on. Consumers are facing much higher home prices, rising mortgage rates, and falling affordability. However, buyers are still actively in the market. That's according to Lawrence Yun, the National Association of Realtors chief economist. He goes on to say that the sales for March would have been measurably higher had there been more inventory. Days on market are swift, multiple offers are prevalent, and buyer confidence is rising. Median home price for existing homes for all housing types in March was up to $329,000, which was up 17.2% from March of 2020, where it was sitting at $280,700, as prices increased in every region. March's national price jump marks 109 straight months of year-over-year gains, so nearly 10 years of year-over-year price appreciation. Total housing inventory at the end of March amounted to just over 1 million units. That was up 3.9% from February. So we have started to see inventory increase slightly. However, inventory is actually down 28.2% from a year ago, where we had nearly 1.5 million listings. Current unsold inventory sits at 2.1 months supply, marginally up from February's 2-month supply. That's a trivial difference. And it's down from a 3.3 month supply recorded in March of 2020. Inventory numbers continue to represent near historic lows. This data is pretty interesting as well. This article goes on to say that first-time homebuyers were responsible for 32% of home sales in March. That's up slightly from a 31% for first-time homebuyers in February, but it is down from 34% in March of 2020. So first-time homebuyers are still making up a large portion of the market. However, as home prices have risen, those numbers are coming down from where they were previously. Now, as far as individual investors or second home buyers, who actually accounted for many of the cash sales, they purchased 15% of homes in March, which was down from 17% in February, but up from 13% in March of 2020. All cash sales accounted for 23% of all transactions in March, which is actually up from 22% in February and from 19% in March of 2020. So there are more cash sales today than there have been in previous months and previous years. Now, to piggyback on what we were just saying with regards to buyer confidence rising, let's take a look at an article from the Mortgage Bankers Association that actually says purchase originations are on pace to increase 16% to a record 1.67 trillion in 2021. Now, of course, they are referring to purchase volume, and with prices increasing, it means that there will be larger loan amounts on average. So it's not necessarily referring to number of units, it's just referring to actual purchase volume. Housing market is incredibly strong this year, with robust housing demand in nearly every part of the country, driven by improving economy, which I want to touch on here in a second, households seeking more indoor and outdoor space, millennials reaching their prime home buying years, and still very low mortgage rates. With regards to the improving economy, if we are talking about the economy as a whole, is it improving? I would ask, compared to what? We still have record high unemployment, which is an indication that the economy is actually weakening. But if you're looking at the stock market or home prices, they're obviously completely elevated. Housing's at record high, stock market is at record high. So in that regard, sure, the economy is doing well, but there are several sections or sectors of the economy that I think are struggling. This is something I would push back on a little bit. Article goes on to say a lack of supply is the biggest hurdle to an even larger increase in home sales. The widening imbalance of supply and demand is driving up home price growth and eroding affordability, especially for entry-level buyers. So I actually believe that this is 100% on point. We have a supply and demand issue. There is very low supply, very high demand for purchasing a home. We have lots of families, particularly the millennial group, is looking to have these household formations. They are starting to have kids. They're starting to expand their families. They want to get out of their current living situation, whether that's renting or living with their parents, and they've set aside some money to purchase a house. The challenge is that with rising home prices, the down payment they need to come up with is much larger at this point. So they're looking at loans that might be like, an FHA loan that requires, let's say, 3.5% down, or if they're a veteran, maybe a VA loan that requires 0% down. Or you could also look at a conventional loan, which, depending on how you qualify, you could do 3 to 5% down. The challenge with a lower down payment like this is that a lot of these entry-level buyers, they have just enough saved for the initial down payment and the closing costs. And when you're looking at purchasing a property and having to go way above the list price, a lot of times appraisals are starting to fall short. And if that's taking place, then a seller is going to probably favor an offer from a conventional buyer who has substantially more funds available to put down. And I think there's a lot of that going on in the market right now. Now, what's interesting is that even though this article is talking primarily about purchase, they also touch on the refinance volume that took place last year. So after last year's record 3.8 trillion in mortgage originations, the MBA, Mortgage Bankers Association, forecasts volume to fall 14% this year to 3.28 trillion, which would actually still be the third highest total ever. So mortgage rates are expected to continue rising to around 3.7%, contributing to a further slowdown in the refinance demand. Refinance originations are expected to fall by about 33% to 1.62 trillion. Refinance volume has already trailed off because of the steep climb in mortgage rates, which recently they have trended back up. They're still very low, and that all took place since January. Mortgage lenders should continue to prepare for the transition to a strong purchase market and slowing refinance activity. So we're definitely seeing this in the market. Rates have trickled up a little bit. They're still historically low, but I think that a lot of that refinance volume took place last year. Okay, so let's switch gears slightly. Now let's talk about where mortgage rates are today. As I mentioned in prior videos, mortgage rates tend to follow the 10-year Treasury yield. Very easy to find. go to cnbc.com, click on bonds, and it's like the first thing that pops up, U.S. 10-year Treasury yield. And for those of you who are not familiar, usually mortgage rates tend to track the 10-year yield in a lockstep fashion. In other words, if the yield goes up, rates tend to rise with it. If the yield goes down, rates tend to go down with it. We have a 1-year chart up on the screen, and you can see that if we go back a year, the 10-year was sitting at, 0.5, 0.6%. And it stayed relatively stable for about 6 or 8 months, and then we started seeing it trend back up. So we're at just about the highest we've been in about a year. I think a couple weeks back we were at 1.74, which is the highest it's been in a while. We're down slightly, which means mortgage rates have actually come down a little bit from where we were a month ago. Now let's take a look. So up on the screen is a national survey from Freddie Mac showing where interest rates actually are hovering on average. These are updated weekly, shows the 30-year fixed, the 15-year fixed, and a 5-year adjustable rate mortgage. I really only pay attention to the fixed rate in these cases, but you can see they're still very good. I mean, 30 years sitting at about 3%. Depending on the fee structure, I've seen anywhere from 2.875 to about 3.1%. The 15-year fixed sitting at about 2.29%. I've seen anything from 2.25 to about 2.5%, depending on the fee structure here. If you're looking at the chart, we can see that mortgage rates definitely ticked up a little bit, and at the beginning of April they were sort of at a peak, and since then they've sort of come down. So rates are still historically very, very low. If we look at a 10-year history, rates are obviously tracking still at the lowest level they've been in quite some time. So it's a phenomenal time to lock into fixed rate debt. Whether that's a 30-year, a 15-year, or anything in between, fixed rate is the key here. All right, so I want to wrap up this video by talking a little bit about the Sacramento market and what I am seeing. Now, I alluded to it earlier, but first-time buyers and entry-level buyers, they are having a very tough time in this market. As an example, those that are getting qualified with a VA loan, which requires 0% down, or an FHA loan, which requires 3.5% down, or even a conventional loan, anywhere from 3 to 5% down, they are facing some challenges because most of the listings, if they are priced correctly in this market, are getting right around an average of 5 offers, most of which are over ask, and they are waiving things like the appraisal contingency, in some cases waiving their inspection contingencies. I don't see it too often where they're waiving the loan contingencies. Me personally, I feel that's very, very risky, but we are seeing a lot of those contingency waivers. The challenge with that is, let's say a property is listed for $450,000, and let's say we get offers that are roughly 10% over that list price, bringing the contracted price up to, let's call it $500,000 for easy math. If we go to the lender and we submit the file, we order the appraisal. If the appraisal were to fall short, let's say it only appraises at $475,000, that buyer would be on the hook for the difference from $475,000 to $500,000, especially if they waive the appraisal contingency. Now, in some cases, of course, you can go back to the seller and try to renegotiate, but many times right now, because of how competitive it is, they're not willing to do that. Instead, sellers are leaning towards offers that are either cash, they're waiving the contingencies, or the buyer shows proof of funds that they have a substantial amount of assets behind them in the event that something like this were to take place. So my advice for those out there that are just getting started, I would say be extremely patient. Purchasing a home in this market is entirely possible, but you need to go in with the expectation that you're probably going to have to look at several homes, probably going to have to make 5 to 7 offers. You're going to want to understand value. You're going to want your agent to understand the market and understand what you can and can't do. And of course, I would suggest being extremely cautious with regards to the contingencies that you're willing to waive. Instead of waiving the appraisal contingency altogether, maybe you put a cap like, hey, look, we're willing to pay up to $5,000 or up to $10,000 over that appraised value. And just kind of rein that in a little bit so that you're not taking an unnecessary unnecessary risk. But anyway, hang in there, keep your head up, keep looking at property, keep making offers. Deals are made every single day. And on the positive side, we are starting to see more inventory come online. As that continues to play out during this selling season, you're probably going to see more opportunity. With that being said, that's going to wrap it up for today's video. I hope you found the information useful. Please leave your comments and questions below. And if you haven't done so already, please smash the like button to push this content out to more people. And consider tapping the subscribe button to see more weekly videos on finance, real estate, and investing. Thank you again for taking the time to watch this video. Take care.